Bismillahirrahmanirrahim. I want to talk about how banks create money out of thin air, quite literally. And if you're not aware of how they do that, then seriously, you are not aware of the biggest joke that was hurled on humanity in the modern age. So stay tuned and watch how banks create money out of thin air, quite
Okay,
hilariously.
guys, we want to know what banks are. So, what is a bank? A formal definition is that a bank is a financial institution licensed as a receiver of deposits. Okay, simply talking, a bank is a lawful organization, depending on what lawful means to you, which accepts deposits and blah 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 blah.
Okay, guys, we're going to talk about how banks make money out of thin air, like literally. A bank holds deposits from its customers, but it doesn't just hold that money. If all banks just held money, there would be no profit in that. So what a bank does is that it takes that money and loans most of it out. Why can't it loan out all of its money? Because sometimes customers can all come in to withdraw their money, which the bank would have very conveniently loaned out. This is called a bank run, and it is awkward. So by law, generally banks are required to hold 10% of their customer deposits, and the other 90% they can loan out. Let's say someone goes into a bank and deposits $100. Now this won't change the money supply because this money from the person's pocket is already part of the money supply. So far there has been no change in the money supply. But here's where the magic happens. The bank is gonna hold, say, 10% by law, that is $10, and loans out the other 90 out. So the person who deposited $100 in the bank has $100, but the person who borrowed that $90 also has $90. That $90 was money that was created out of thin air that didn't exist until the loan occurred. Now that person is eventually going to spend that $90, and those $90 are going to make their way to another bank. That other bank is going to take that $90. It's going to hold 10% as required reserves, so that's $9, and then it loans the other $81 out. Now guess what? That $81 is new money that was created the moment the loan occurred. Then eventually the person who borrowed the $81 is going to take it and spend it, and this $81 is going to make its way to another bank, and the same thing is going to happen again and again and again. It turns out that the initial deposit of $100 creates $900 of new money created out of thin air in the money supply. This is called fractional reserve banking. All banks work according to this principle, wherein banks hold a portion of deposits and loan the rest out. And whenever they loan it out, remember, they create money out of thin air. Yeah, absolutely.